All right. Hello, everyone. Welcome to our webinar. Hello, DJ.
Hi, Julia. Hi, everybody.
Let's get us set up for recording and going over to our social media, and we will start momentarily. All right, we have lots of good news to talk about today, right, DJ?
We do. Yes, we do. It's going to be an optimistic, uplifting webinar.
Yes, we made it to 2023. We'll take it.
I think we're all glad about that.
Yes, yes. So we had over 100 people register for this webinar. So we know that this is a hot topic, and we're going to talk about the markets. And then we're also going to talk about the upcoming tax season. It just goes by quicker every year.
It does. Markets and taxes. I mean, what more do you want, you know?
All right. So I will share my screen and we will get started here. So we have a new process for asking questions. So due to compliance reasons, we are not able to use the chat and the question feature on the Zoom platform. So I want everyone to take out a pen and paper and write down this phone number, 458-777-4458. If you have any questions during this, please text those questions to that number. You can actually save that number in your phone for texting Financial Freedom Wealth Management Group. Any question you want, we actually have texting ability now. But specifically for this webinar, we will make sure to get all of your questions answered by the end of the webinar today. So a little bit about us. If you are new to us, we are Financial Freedom Wealth Management Group. I founded the firm in 2001. We are a comprehensive wealth management firm committed to helping our clients improve their long-term success and pursue financial freedom. Who we serve are pre- and post-retirees, or pre-retirees and post-retirees. We can help you decide when is retirement a good, when is timing right for you? And then also, if you are in retirement, how to protect and build your wealth. Also, if you are new to wealth, maybe you received an inheritance, maybe you just got your first job and you want to start saving and investing for your future, so we can help you develop and grow your wealth. And then we also serve business owners, so we can help you with exit planning in your business, how to build wealth in and outside of your business. And our commitment is to always care deeply about you and your financial life. Here is a picture of our team. So currently we are a team of 7 wealth advisors with 13 support staff. Although there are a couple new team members that are not pictured here. And today I have joining me is DJ Wright. He is our investment manager as well as a wealth advisor. And we are excited to hear from him. He loves to discover and monitor investment opportunities. And he is also instrumental in crafting the various portfolios that we use for our clients' investments. As a wealth advisor, DJ is passionate about serving our clients across the nation and providing guidance to help them pursue financial freedom. DJ received his bachelor's degree from the University of Oregon, where he focused on economics and business. This was years ago, right?
It was, yes.
And he enjoys being outdoors, all things sports, and spending time with his now 2 sons. So welcome, DJ, and we're looking forward to hearing from you.
Thanks, Julia. And let me just briefly introduce you. Julia is our founder and CEO, and she started the company back in 2001. It's crazy, right? Time is flying, I bet. Over in Newport, Oregon, and that's where she still lives today. And Julia's done so much for this industry, in this industry, and she's a great leader for our company. She's got her husband and 3 kids, which some of them are at home. And don't you have a daughter
Yeah,
that's
one is out of the house,
there you
which,
go.
yeah.
All right. Well, thanks, Julia. So let's talk about these markets. And just to recap, if you need that number, go ahead and take it down now. But that's the question number. But let's talk about the markets. So I think the main theme here is how quickly things can change. So 2022 was a tough year. I think we're all glad to be done with 2022. Stocks were down in a bear market, but then you also had bonds that were hit hard due to rapidly rising interest rates. So, typically when stocks are volatile, you'll have bonds that you can kind of lean on. It's like a safe haven investment. And that was not what we saw last year. So it was all around a really tough year for investors. Well, here we are in February of 2023, so still early on, and things are starting to feel very different. So this year has already been very good for the stock market. The S&P 500 is up 7.5% so far this year, in just a little bit over a month. And then we have the NASDAQ, which was really hit hard last year, and it's up more than 14%. So we're not out of the woods yet. We'll likely continue to see some volatility going through this year, but there are a lot of things to be optimistic about, and we will discuss some of those here today. So economic growth is going to slow down. Pretty much everyone agrees on that. And that's actually been the goal of the Fed over the last year, to actually slow down the economy, which will then lower inflation. So we're expecting GDP growth. GDP is gross domestic product. It's the primary measure of an economy's economic growth, to be pretty much flat in the US. So with this lower GDP, this economic output, inflation should come down. And so we've already begun to see that this year. It looks like inflation has peaked. So the expectation for inflation year over year is about 3.5% is what we're expecting come the end of the year. Whereas in 2022, we were at 6.5%. So this would be a significant decline. We'll see how that pans out. But again, we are expecting much better inflation numbers this year. And then you can also see that, the US is actually looking better than other parts of the world. So one of the big questions for 2023 is, do we officially enter a recession? Everyone's kind of waiting, wondering, and I'll explain this graph here in a minute, but first I want to discuss the recession talk that we're all hearing. Most economists are expecting a mild recession. Now, this is nothing like 2008. It should not be as severe as that. And then there's actually some who are saying we may even avoid one altogether. So you've probably heard soft landing versus hard landing. Those terms have been thrown around. So a soft landing is where, the Fed is able to slow the economy down, bring inflation down without actually throwing us into a recession. So that would be kind of the best case. We're hoping for that. Whereas a hard landing means they actually had to slow the economy down enough to throw us into a recession in order to get inflation down. So that's still up in the air. We don't know what's going to happen, but regardless of what happens, whether we go into a recession or not, it's important to remember that the stock market is very forward looking, about a year. So you can kind of think of the stock market as it's like a window into how people are feeling about the future. So a lot of the pain that we saw in 2022 could be behind us as we look forward into 2024, where any potential recession would likely be over at that time. So, with that said, you can see here that there are a lot of indicators that are leaning towards a mild recession. So you see this blue line here. This is what's called the leading economic index. So it basically forecasts future economic activity. In the past, when we've seen a significant decline, it was followed by a recession. And so you can see here that we've seen it drop significantly. So that could be a telltale sign that we may enter a recession here. But again, it's not necessarily a horrible thing for the stock market because that the market's forward looking. In the past, we've actually seen stocks rise during recessions, again, because they're looking forward to the next growth phase. So a Fed pivot, this is another important piece that we're watching. What's the Fed gonna do? Will they pivot, meaning will they change their stance on inflation and raising interest rates? So we know that they're near the end. They recently raised interest rates by 0.25%, whereas last year we saw some huge rate hikes of 0.75%. So they're getting to the tail end of it. Now, if they see inflation come down enough to where they can actually end their rate hikes sooner, that could be a positive sign for the market. That could be good for stocks. So we're likely going to find out here in the next few months what their path is going to be. A lot of it depends on what happens with inflation. So, we should know a whole lot more in the next few months. We'll see what happens with the Fed. Now, when the Fed does pause their rate hikes, because again, that's eventually going to happen, history tells us the stock market does pretty well. So you can see the market gains here for 3 months, 6 months, and 12 months later. So when you look at 12 months, the average gain after they pause rate hikes has been 10%. So this is another promising statistic that could be good for stocks, as we know they are likely to pause here in the next few months. So we could see a good bounce from that. Stocks have also done very well the year after a down market. So this is regardless of what caused the down year. There's all kinds of different things why markets experience downturns, but regardless of it, typically we see a good bounce back that very next year. So this shows us 18 times that the market was down since the 50s and what happened that very next year. Pretty great returns. I mean, look at these. A lot of these are quite high. So the S&P 500 was up 15 out of those 18 times with an average gain of 15%. So think about all the things that we went through over those 70 years. I mean, there's been wars, there's been recessions, financial crisis, there's been all kinds of things. And we still see that, if you're patient during those downturns, you're usually rewarded, and generally the very next year. So that's the key here. Got to be patient and not react to the downturns in the market.
Exactly. And I'll just add on that, DJ, that's so good. And also, we don't know when those returns are going to happen. So much like we saw just in January, how fast it can come back and have positive returns. But if you were out of the market in January, you would have missed out on that good month for the year.
Yeah, exactly.
Yeah, you have to accept all the bad with the good.
And you're right. We'll see a lot of these big swings, these big up days in a handful of days.
Mm-hmm.
You can see some really huge. I mean, we've seen like 4 or 5% swings. And so if you miss one of those, it can really, really hurt you long term.
Absolutely.
All right, so let's talk about bonds and interest rates. Again, we're coming off an extraordinarily rough year for bonds. Something that really it's like once a century. We've never seen it before. It was the worst year. So we're actually optimistic going forward for bonds. So this shows us, various interest rates for these different bond indexes. And what I want to point out here is that, although it was really tough last year, rates have finally come up. So now you can actually make some money in these bonds. You can actually earn interest. So if you see here in the middle, you have what rates were back in October, And so, if interest rates didn't change and you held these bonds for a year, that's about what you could expect. That's what it would pay you. The other side of the equation on how bonds do is when interest rates change, the price of the bond can change. And so there's that inverse relationship. So when interest rates are coming up, you actually see the price of the bond go down. So that's what a lot of those losses were last year. So for this year, you can kind of see the estimates, if rates actually come down a little bit more, which we've actually seen them come down, you could, expect even more of a return than what that bond is paying you. Of course, if rates do go up, it eats away at some of those, some of the return as well. So bottom line is bonds are looking much, much better, and don't abandon them just because we had a hard year last year. So let's talk about the stock market in relation to politics. It can be a tough conversation to have, but it's important that we do it. So stocks have always been positive the year after midterms, no matter who is in office. So this is the third year of a presidential cycle. And on average, it's been the best year of the 4-year cycle for the stock market. It's averaged almost a 15% gain for all those years in the past. And again, the key here is that it doesn't matter who was the president, who was in the White House. We can easily let politics affect our investing decisions. And I think that that's normal for most of us, really is, but it's not the best strategy. And this is regardless of which side you're on, whether you're a Republican or a Democrat, doesn't matter. You kind of want to separate that from your investments. We don't invest in presidents. We invest in good companies, lots of them. And these companies find ways to make money regardless of who's in the White House.
Very good point. I like that.
It's tough to do, though.
It is because we get all emotional and
yeah, we totally get it.
Yeah.
Now, if you look at the numbers, a Democratic president with a Republican or split Congress has actually been a strong combination for stocks. You can see that here, some really great gains on average. And so, that's exactly what we have this year. So you can see the average gain has been 15.9% with our current situation. So this is another positive outlook for 2023. Now, of course, we never know what's going to happen in the stock market. We can't predict it. You can't time it. We can look at history and use all the data to come to some conclusions, which is what we're doing here. And, when we look at these various, data points, metrics, themes in the stock market, really what they all tell us is that the market is resilient. It does very well over the long term, and sticking with your investments and not reacting to volatility in the market is generally the best strategy. Again, easier said than done, but that's what we can, we help our clients do is to stay the course and stick with it.
Very good.
And Julie, I'll send it back to you. Let's talk about some taxes.
All right. So again, we'll put this phone number up where you can text your questions. So we'll make sure to get all of those at the end. So let's transition now and let's talk about taxes for for 2022. So these are the tax rates for last year, and then what you will be filing your tax return for. We have a progressive tax system, which is meaning the higher income you go, the more federal taxes and state taxes. If you're in a state that has taxes, you'll pay. So we have 7 brackets inside so this is for federal. If you are a single taxpayer, you can find your income level, and then to the left will be your tax bracket or the tax rate that you're in. And then married filing jointly, you would take, if there's income for both partners, then you would add those together. and then find, so let's say if my spouse and myself made 180,000, we would be right $2,000 into that 24% tax bracket. So you can follow. It's important to understand which tax bracket you're in, because as you look at strategies, in the case I just gave, we could say, oh, $2,000. If we put $2,000 into a tax deferred retirement account, that would take us down into the 22% tax bracket. So it's a big difference if you're in between the 12% and 22%. That's a 10% jump there. So important just to understand how it works. The other thing is the 2022 standard deduction. So I think, gosh, over 90% of us take the standard deduction on our taxes, and we don't itemize anymore. Although sometimes you will find that you itemize on state return and take the standard deduction for federal. So it can be a little bit confusing. But if you're single, you would deduct $12,950. And if you're married filing jointly, it would be $25,900. If you are over 65, there's a little kicker for each partner that's over 65 that would increase that as well. Capital gains tax is also very different than ordinary income tax. And so if you have long-term gains, which means that you're holding an asset, it could be real estate, it could be a stock or a mutual fund. If you're holding that for at least 12 months, that's when you qualify for capital gains. And capital gains tax is less than your ordinary income tax rate. So if you're single and you have income of less than 40,000, then you would be in the 0% capital gains rate. And then married filing jointly, 80,000, that means your capital gains rate is 0. And so when we look at, in our business, when we look at non-retirement accounts that are paying dividends, like if you have a fund that's paying dividends, if you're below, if you're in that 0% capital gains tax rate, that means those qualified dividends are taxed at 0%. So it could be very advantageous for you to, I mean, that's what we're looking at, to make sure that your investments match your tax, what tax situation that you're in. So it's good to understand the differences between the capital gains tax and the ordinary income tax. So if you are in accumulation mode and not yet retired, it's really important to understand if a Roth IRA or a regular IRA, or if this was in a 401k, we call it pre or post-tax contributions, which is better for you. So if you look back to the slides I just shared, if you fall in the 10% tax bracket, the 12% tax bracket, we're pretty much going to guide you to contribute into a Roth IRA, because you don't really need the tax break for putting the money into the plans for your retirement. The advantage to that is the Roth and the after-tax contributions are going to grow tax-free as long as you follow all the rules for your retirement. Now, if you're in a higher tax bracket, and you want to maybe get down into a lower tax bracket, that's where you want to do the pre-tax, like you want to contribute to a traditional IRA or your pre-tax 401k option, which gives you a deduction for putting the money into those retirement accounts. These accounts are excellent vehicles that we can use that shelter money from taxes as you accumulate that in those accounts. And also for IRA contributions, we have until April 18th of this year to put money in for last year. So there is still time to do that. Another thing that happened with 401ks as well as IRA and Roth IRAs is the contribution limits have increased. So this is going into effect for 2023. So not for last year, but for this year, you can contribute up to $22,500 into your 401k or qualified plan. So if you were maxing it out last year at 20,500, you can go in and increase your contribution now with this new limit. And then for your IRA and your Roth IRAs, it is now increased to 6,500 from 6,000. So for 2023, it'll be 6,500. If you are over 50, you can actually add another $1,000. So it's $7,500 there. Another thing that happened right before the end of the year, this was lost in the headlines, I think, but they passed what they call Secure 2.0. And some of the key things that this legislation did was that it increased required minimum distributions, the age of required minimum distributions to 73. So if you are 72 this year, you will not have to take money out of your IRAs. So we had some happy clients here in the beginning of January. And that will progressively get older over the next 10 years as well. The other thing that they did was they reduced the penalty tax if you missed a required minimum distribution, like you did not take that money out of your IRA and you were over the age limit. They used to penalize you with a tax of 50%. So if you're supposed to take out $10,000, the penalty for not taking it out was $5,000. So that was pretty steep. They've reduced that now to 25%. Which is still a pretty big penalty. But if you actually correct it in a timely manner, then they will reduce that to 10%. So if it was a little honest mistake and then you catch it, there's some grace and forgiveness there. So I like seeing that because that penalty was pretty steep. Another thing we love to talk about because we have very cheerful givers in our client base is that these qualified charitable distributions are still available and come into play once you turn 70 and a half. Qualified charitable distributions are coming out of your IRA and going directly to a nonprofit and charity of choice. So that actually counts as your required minimum distribution if you are now over 73. The nice thing about a qualified charitable distribution is the money actually stays off your tax return. So typically you have to itemize on your taxes to get a deduction for charitable contributions. So this allows you to get that deduction if you do it, not get the deduction, sorry, but it's actually, if you take it straight from your IRA, give it to the charity, that income is never going to show up on your tax return. So, if you are a client of ours and you are 70 and a half and you do giving and you have an IRA, talk to us about doing this. There's some simple things that we can get set up. You can have essentially kind of a checkbook for your IRA where you can write checks and do that giving. So it's a very good benefit to utilize. All right, so the deadline this year to file your taxes is April 18th. That's also the same deadline to put in your IRAs for the 2022 tax year. If you are going to file an extension, this is the date that is due. For all of us that do estimated tax payments, those quarterly estimated tax payments, that's the date that you need to send in those checks by. And then just a note for all of our clients tuning in, the tax documents, the 1099s should be arriving. I know the first wave is already out, maybe even the second wave, but those will keep happening through mid-March. And the timing on that is based on how your investments do the reporting. So all the investments that you invest in have to do the reporting to our broker dealer, LPL Financial, and then LPL sends that information on to you as the taxpayer. So we are happy to answer any questions for you. Those tax documents are also available online in your secure portal if you are a client. But if you need help, please reach out and we can answer any of those questions. And all right, so I'm going to put actually, let's go to the next screen because this next screen has the phone number on it too. And I'm getting dings. Those are all the questions coming in. So if you are a client of ours and want to connect with us about taxes or the market, or if you are brand new to us, welcome. We would love to have a complimentary consultation with you. There is no cost or obligation. We find that people gain great value from the time together. We can answer questions. We can look at your investments and just make sure that you have a solid plan for your retirement and your financial future. So you could go ahead and text FREEDOM to that number to schedule the review, and we'll help you coordinate that. So thank you for attending today, and we look forward to helping you and continue to help you with your financial lives. We have to do a little bit of disclosures here. So again, we are partnered with LPL Financial. They're the largest independent broker dealer across the nation. Their membership is in SIPC, which is Securities Investors Protection Corporation. And so essentially what that means is if LPL were to fail, go bankrupt, then SIPC comes in and ensures that all of protocol is followed, your assets are safe and in custodian there. So there is that. And then some small print that I don't think I'll read. Do you want to read it?
Nah.
Okay, so then let's go back and we'll land on this page. And then let me get to the questions here. Okay, so we have a question. Do we pay taxes on draws we make from regular mutual funds that are not a retirement account? Ooh, that's a really great question.
That is a good question. So it depends. It's not the full amount that comes out of the account that's taxable like in an IRA. It all depends on the capital gain. So when you bought it, what we sell it at that time. So you can, you could sell an investment in a taxable account and not even take the money out, but it could be taxable. You could also sell an investment that was down and take the money out. It wouldn't be taxable. So it all depends on how that specific investment that you sold to get those funds had performed since you bought it.
Correct. Yes. And then also if the fund pays dividends, that could be income that part of the income you could take. So that would be taxed based on what your tax rate is. So if you're in the lower tax rates, that could be 0, it could be 15%, or maybe even 20% if you're in the high tax bracket. So very good. All right. Verifying that if taxable income that is over a tax bracket, only the amount over is taxed at the higher rate. Yes, I did not say that, but that's the progressive system that we're in. So if you're over the 12% tax bracket by 20,000, only the 20,000 is taxed at 22%. And then the rest is taxed at 12%, and then a little bit taxed at 10%. So it is progressive. So your effective tax rate is the blend of all of that. Any recommendations for small business tax record keeping software? I mean, the most common one is QuickBooks. If it's a small business, like a sole proprietor, it could be Quicken. That is not as robust as QuickBooks. But there's also some new bookkeeping companies out there. I don't have any personal experience. How about you, DJ? Do you have any?
No, I don't. No.
Okay, good questions. If charitable giving amount does not extend beyond the standard deduction amount, assume it's best to just take the standard deduction. Yes, that is true. So if you would take the standard deduction, and that would be inclusive of your charitable. So the only caveat to that is if you're over 70 and a half, then you could make that charitable distribution straight from your IRA. Okay. Any other thoughts? I think I got all of our questions.
Oh, here's one other one. If you lose 20% in a year, what would the gains need to be to get back to square one per se? I have read it takes higher gains to make up the losses. So yes, that's correct. You know, so let's say you had 100,000, you lost 20%. So now you have 80,000. So to get back to that 100,000, now you need a 25% gain, which would get you back to the 100,000. So that is correct, that you need a little bit higher to make it back. Yeah.
Yeah, but what I've seen over the years is when you have pullbacks like we've had, the recovery is usually pretty drastic, pretty quick. So, it could take 2 years, or, in 2008, 3 years to make back to your high water mark. But when you have 15, 20% pullback, typically we see that recovery within a year, I would say, since the 90s, since I've been doing this. Mm-hmm. So, yeah. And especially if you're adding, so if you're in accumulation mode and you're adding money while the market is down, that's why, your 401ks can look awesome in times like we are right now, because all of last year we had very volatile ups and downs. But if you added money when the markets were low, right now you're positive in those times, in those months, because the market came back so strongly here in the last 6 weeks.
Yeah, and so if we go back to 2008, which was one of the worst recessions, downturns we've seen in the 100-year history that we track the stock market. If you just held on tight, it was less than 3 years to recover everything. And then, as Julia was mentioning, if you added along the way, well, that was even less. And again, that was one of the worst, the second worst in 100-year history. They're typically much, much shorter than that. So, yep.
Yeah, it's as long as I feel like I've been doing this and understanding the market. Now you, DJ, I know you followed this for probably at least 10 years watching stocks, and before you worked here and then during your tenure here, it's amazing when we have these down markets and the emotions that go into play. And then I think the hope that it brings when we see kind of the recovery and the way out of it, that, like you said, the markets are resilient. We will get through this. And on the other side of it is a new bull market that we'll be in and that will prosper through. So,
yeah. And the good news is, the average bull market is 4-5 years long, whereas these bear markets, the average is less than a year. So we're in bull markets a whole lot longer than we are in these bear markets. But of course, the bear markets can feel long because it's stressful and tough to get through, but that bull market is always around the corner. It's always coming.
Yeah. Yeah. All right, everyone. Well, thank you for participating today. That was some great questions, and we will be back in a couple months. So be on the lookout for the next webinar and the topic. And we always love feedback. So if you have topics you want us to cover, if you have questions, we are here to serve you. So thanks for tuning in.
Bye, everyone.